So this is homework number 2 for Warrior Trading. Again, this is my kind of video docu-series on Warrior Trading and my experiences. So I tried to upload a video, but I guess my phone is running out of space. So hopefully going live will work here. So the first question in homework number 2, what is the profit-loss ratio? How do you find your profit-loss ratio? So the profit-loss ratio is something Ross kind of stresses. Whenever you enter into a trade, you want to make at least 2 to 1 on your investment. If you can't do that, then 1 to 1 is bare minimum. But again, you just want to kind of get in. If you get in at $1, you want to make $2, right? So that's kind of like the profit loss ratio. Number 2, what metrics does every trader need to know in order to be profitable? So you want to know, what time of the day do you trade best at? How much money have you lost? How much money have you made? What types of stocks do you bid on? What's the average price? Just all those different types of metrics will help you understand yourself as a trader, and then you can kind of refine your skills based off that information. What methods can be used to manage risk? So, going through your plan and strategy, executing it, not being an emotional trader will expose you to less risk. Keeping your trade for a longer duration, the longer it's in the market, the longer you're more apt to risk your price, whatever you bid at, a number of shares. So all those things factor into your risk management. How are you going to enforce max loss per trade and max loss per day? So he talks about having a mental stop, but there are some like programmable triggers to sell or buy. So those are good ways to manage risk, but he says the most experienced traders don't do that. And then what usually happens is you become emotional, and then you kind of run the risk of, it's more risky. But I think I'll move towards more like practicing the mental stops, because everything seems to go really fast, and then just the thought, I know you could program stops on top of buys, but something, if you don't get in right, then you might be out real quick, and then you have a loss. And so I think having a mental stop will probably work better in my favor. What is it going to be your approach for managing risk? So just be more conscious of it. Again, everything I talked about how to manage risk, and so just being aware of my emotional state, and then all the other things that expose you to losing money, right? So any contributing factor that could cause me to lose money, that's risk, and it needs to be, you need to be mindful of that. What is halt risk? So halt risk is basically when a stock, circuit breaker stock, stops from whatever reason going up too high or going too low, and there's a freeze on the stock for trading. And so when your money is locked in that market during that time for 5 minutes, you are at risk for a halt, and it could turn either way when it turns back on. So that's the risk you run with these type of momentum stocks. Next one is what is float and spread risk? So float is the risk you run with the momentum trading strategy. You're trading stocks that have low float, because there's more demand when you have less circling supply of stocks. For whatever reason that kicks off the demand. If you have a low amount of circling supply, then the supply demand, right? The price is going to go up when everybody wants to buy it. So that's the risk of, so that means it's volatile, so it could swing either way. And then the spread risk is kind of like how much because it's so volatile, how much the price can fluctuate and spread. Is basically so how high it can go up, how high it can go down. you run the risk of that really quickly with these types of stocks that you target. What is slippage? So slippage is when you want to execute an order or sell, and you click to buy that button, and just pretty much lag it takes from you to do something. You see it, click it, talk to the exchange, go through the net, and buy or sell. That difference is slippage. So that can cause you to sell at what you don't want to sell, or miss a buy when you want to buy. So everything is not that quick of an instant. There's like that slight minuscule amount of time where everything is not instant. So within that, there's errors. Well, not errors, but you just slip. You don't get what you want to get when you see it. So that's just part of the game. Yeah, and that looks like that is the conclusion of homework number 2. So I will go into homework number 3 now.